Hi, I'm Greg Weldon. I'm your host for Money Markets and New Age Investing. And I just looked to see what episode this was. It's season 4, episode 5. And it really shocked me to see I haven't put out a podcast since April 11th. I'm sorry about that. But, with this war and with one day we're going to wipe the civilization off the face of the planet, and the next day is we're this close to a deal, a negotiated deal. And that goes back and forth every day for the last 6 weeks. Well, you know where I've been, buried in my cave here, trying to handicap markets that are not handicapable, if that makes any sense. But I can say what's really interesting is the macro backdrop, the micro that's, it continues to expand in terms of stagflation. We've been talking about this now for a couple of months and how this is now coming above ground and being noticed. And we're going to kind of go with some international flavor today, because some of my focus has been, that this is a global issue now, not just what's going to happen next in the U.S. This is what's going to happen next to most of the world outside of Russia, China, and OPEC and the Middle East. All right. I'm going to start with a piece, and I've done 3 pieces on Europe recently, April 29th, May 1st, May 21st. The May 1st piece was about stagflation and inflation and deflation in the economy, and it was a German phrase, and so it was pretty interesting. And then May 21st, I did the piece called Hello Ball. And if you remember the Ralph Cramden, if you remember the Honeymooners, I'm old enough, you probably have no clue who I'm talking about, but it's basically a bus driver who has all these get-rich-quick schemes, and he basically convinces his depot boss at the bus depot that he can play golf. So the guy invites him to come play golf as the guest championship at his country club. Well, Ralph doesn't know how to play golf. He's never played golf in his life. So him and his buddy Ed Norton, they're always in on his scheme, who works in the sewer, get together, and Ed buys a book, and he's going to learn how to play golf in a single night. And the very opening of the book is, first thing you do is address the ball. Well, neither one of them knew what the hell that's supposed to mean. So, Norton kind of pushes Ralph away. Let me show you. I know what it is. It waggles the club a few times, and then tips his hat and goes, "Hello, ball." And Ralph just goes crazy, and it's just one of the funniest scenes of all time, in that kind of slapstick comedy dynamic. But in this case, it's both funny and yet serious, because it's Hello, Mila. Hello, Mila. And what does that mean? Well, Mila is what the Bundesbank, the German central bank, just introduced in the last couple of weeks with their May monetary report. It was literally last week. We're talking a week ago. They introduced Mila. Mila is the monetary intelligent language agent who is going to guide us through the Bundesbank's decision and guide us through the macro forecast that Mila is going to provide for the Central Bank of Germany, the Bundesbank, one of the most respected banks, since World War II, that's out there, and still lurking, still doing really good research. And what's interesting about it is, when you start to look at what's going on in Europe, yeah, it's problematic. I mean, it really is. I mean, I start with, the EU's Commission's consumer survey. All right, and this is updated material. It's for April, published in May. All right. The inflation estimate, and this is coming from the EU Commission, but is the ECB's data. All right, the inflation estimate from the fourth quarter now to the first quarter has been lifted by 0.7, while the GDP estimate cut by 0.4. I mean, that's stagflation right there. Higher inflation by 0.7, 4 tenths less on GDP. That's a 110 basis point swing. That's a full 1% from stagflation that's impacting already. All right. Now, check this. This is the Bundesbank stuff. I'm sorry. I'm a little ahead of myself. I'm already on the EU Commission. That's next. This is the Bundesbank saying this. This was their estimate for Germany. For German growth was revised up 0.7 for inflation, down 0.4 for GDP, 110 basis point swing on stagflation. Then the Bundesbank went on to say, in their money supply report, that both investors and households were showing a high preference for liquidity. There was substantial additions by households to overnight deposits. People don't feel safe with their money. This is what it's saying. And people want their liquidity. They want to have their money accessible where I can have cash in my hand tomorrow if I need it. Okay? But it goes even further, because I also did a report recently on the ECB's first quarter senior bank loan officer survey in Europe. Well, the Bundesbank picked up on this, man. They did some great work to extrapolate on what the ECB had done. Bottom line is, this was the Bundesbank's conclusions. Your EU area banks are further tightening their lending policies. Lending to households fell off markedly. Do you see where we're going with this? It's called a credit crunch. Not only do we have monetary conditions tightening, central banks are going to hike, the dollar's rising. These are tightened monetary conditions. And you're talking about now we might have we're having a tightening in credit conditions? I mean, this is a double-edged machete slicing away at consumer final demand. And this is the kind of thing that causes a potential crisis, all right? What's interesting here is the Bundesbank went on to warn countries, and it used to be the Bundesbank that had the say over the ECB because they were the badass BMOC, big man on campus. Because a lot of these countries now are thinking about, well, we can use fiscal policy to offset some of the higher prices for energy that consumers are feeling. Bundesbank warning: countries seeking to help must learn from past policies and keep fiscal support temporary. They don't want to blow it out like they did in 2010 that led to the crisis in 2011 where bond markets collapsed. All right. The Bundesbank estimate for EU deficit to GDP has just been lifted for 2027, next year, from 3.1 to 3.6. Annual deficit, from 3.1 to 3.6 of EU GDP. That's a problem because already at 3.1, you're above the hard high limit, which is supposed to be 3%. If you remember ERM and Maastricht Treaty all the way back in 1990, which I remember like it was yesterday, and all the tenets, all the little things in there, including if a country goes above 3% deficit to GDP, they get fined and they have to cut spending. Like it's mandated. So, of course, all of that was done away with in 2008 and 9. That's the problem, and it's never come back. But this is really interesting already in terms of thinking about fiscal policy support for the consumer in the EU. At the same time, the ECB is hiking rates. This is, again, stagflation. It's like we want to hike rates to fight inflation, but we're going to fiscally support the consumer because of the deflation in consumer final demand. Now, the EU Commission's survey, get this one right, Consumer Expectations Trend Index, inflation expectations trend, rose to plus 51 from plus 26 just 3 months ago. It's almost doubled. It's a point shy of doubling. But more than that, at plus 51, it's the second highest reading in history. And this data goes back to 1985, before there was even a union. And before 1985, it was Germany. Not only that, so the inflation expectation trend from consumers in the EU is the second highest ever, and the time it was only higher was in 2022. That's it. So on the flip side of that, there's your inflation, would be the stag, and that's the service sector business sentiment. All right, service sector, bulk of the economy. The business sentiment index for April hit 0.9, down from 4.1 in March, and a 6-year low. Outside of the pandemic, which is the only time it's been lower in 6 years, was 2020. Beyond that, it's the lowest since 2013. Then we go to the ECB's consumer survey. The ECB's consumer survey for 1 year ahead inflation hit 4%, up from 2.5% in March. It was expected to be up 2.9 according to the ECB, but they missed that one because it hit 4. It wasn't even supposed to be 3. It hit 4. The 3-year ahead hit 3%, up from 2.5% in March. So this is really tough, man. I mean, it really is. And then you start to look at the senior loan officer survey from the ECB. Loans to enterprise and loans to households, demand has turned negative. And the loans to enterprise, it's negative for the second quarter in a row. All right, loans to household demand, the balance fell to minus 20, meaning 20% of banks see lower loan demand from households in the first quarter. That's down from 0. And it's expected to stay at minus 20. I mean, that's massive tilt towards lower demand for household loans. Then for housing loans, for home purchase, all right, there's a heightened rejection rate So the banks are rejecting more home purchase loans. In Germany, a plus meaning you're rejected. Germany went from 0 in the fourth quarter to +4 in the first quarter. Spain from +10 to +10 was already tight. France from -12, where they weren't rejecting anybody pretty much that put in for a home loan in France. Now 0. Italy from -10 to +1. Now tightening in terms of loans being rejected. In terms of tighter lending standards on consumer credit and credit cards for the entire EU area, +16 from +7 and from +5 in the third quarter of last year. And next year, it's expected to go to +18 from +16. So tightening standards, tightening rejections, tightening everything. And the sign that European banks expect this to continue and get worse is very simple in their non-performing loan expectations. In other words, how many people are going to default on their loans? We have to basically, write them off. Non-performing loans, a plus is a bad thing, all right? Non-performing loans for businesses in the first quarter hit +5, up from +3 in the fourth quarter. Expected to be +7 in the second quarter. So they are seeing a fairly high degree of rising non-performing loans among businesses. Among consumers, it's even worse. From -1 in the third quarter of last year, it's at +7 now. Went from -1 to +5 to +7. It's expected to go to +12 in the second quarter. This is a total flip-flop from we don't have any nothing to note in terms of non-performing loans on consumer loans to now it's a problem potentially emerging. So what does this all mean for the ECB? And their policy rate's 2.15. Inflation just jumped to 2.6. It was 1.7 in January. It's 90 basis points higher. It is now a full, 35 basis points above the ECB's policy rate, which means the ECB right now is loose, stimulative. The 3-month rate, which is the deposit rate, is up to 2.86. Take the minus 15% basis point, spread you normally have over the policy rate. And they're looking for 250 rates. So you could say the market is priced in 2 hikes from the ECB. Well, guess what? That's what the ECB tells us they're expecting, 2 rate hikes in the next 12 months. Monetary conditions will continue to tighten when credit conditions in the EU are already tightening. It's already a credit crunch, and now monetary conditions are tightening more dramatically in the EU. Let's talk about the U.S. Inflation is still a problem, and it really bothers me when you see these people talk about, gasoline prices will come way down as soon as the war is over, and inflation is pretty good outside of gasoline. And it's not true, any of it. First of all, U.S. inventories of both gasoline and particularly crude oil are low. They have drawn down huge, even though they've released SPR crude. Why is that? Well, yeah, we produce record amount of crude, let's call it 6, 7, 8, depending on the week. Let's call it 13.8 million barrels. Hell, let's call it 14 million barrels just to get 6 months, 12 months down the road to where they actually are getting to 14 million. Let's say we produce 14 million barrels a day. Our throughput to refineries, all right, in other words, what we're cracking into gasoline, all right, and diesel fuel and jet fuel and all these other things, is over 16 million barrels per day. It's a 2 million barrel, if not 2.5 million barrel gap every single day. So you release some SPR, big deal. Guess what? Inventories kept falling. They're below the 5-year low. And I'm not going to say they're dangerously low, but they're not that far away from it either. And if this thing does go on, and I have my thoughts on the Iran war, we're really not going to get into too much today because you can't handicap it. It's a lose-lose for Trump right now. He's painting himself in a corner. He can't get out with getting paint on himself. He needs to get out before it gets too close to the birthday and July 4th or the midterm elections. And it may already be too late. If it goes in too hard, you'll take another whole spike in gasoline prices, and this will crush the consumer, and it could endanger the Republicans' control of the House, the legislative branch of government. Let's put it that way. So, in all of this, politics that I hate to get involved with, let's look at the macro. The macros are going to change as soon as the war ends. It's going to be one of these things. Okay, well, let's get back to looking at the macro data. Holy macro, the macro. The macro data stinks. Where have we been? Well, no one's been digging. All right. You think inflation is low? It ain't. Let me tell you why. Service sector is still 70% of the economy. We're going to talk more about percentages of the economy as it relates to the stock market, as it relates to semiconductors. because they got some good stuff for you there, man. These numbers are to use the phrase I used to use, I haven't used in a long time. The data is whack, man. It just is whack. It's that simple. All right. CPI, service sector CPI, 81 indexes. All right. Not including energy, which is only two things: electricity, natural gas. So they don't include those. 81, and those are high. Electricity particularly, so above 6%. I think it was. I'm not sure. It might have dropped. It's going to go higher. Bottom line for CPI, 81 service sector inflation indexes. 64%, over two-thirds, almost two-thirds are above 3% year over year. They're not two-something. They're above 3. 47, or nearly half, are above 4% year over year. And you can see some that are above 3 are also above 4. So the numbers don't add up to 100. But you know what I'm saying. Half are above 4%. A third, or 32%, are above 5% year over year. And 21%, 1 in 5, is above 6% year over year. I mean, that's problematic, man. Big time. And the things that are the highest are the things people have to pay for. And this is why not only is it gasoline, it's everything else. Double-digit gains. Let's talk double-digit gains. Household insurance, tenants insurance, garbage and trash collection, auto rental, vehicle service and repair. And that's two things: vehicle service and maintenance, number one, and then vehicle repair, number two, because, of course, they clip you twice. Dental services, delivery and postage, concert, movie, and theater tickets. Ain't that interesting? Dry cleaning and laundry services, public intercity transportation, and one of the biggest, 13.3 for video streaming movie rentals. And let me tell you, Memorial Day weekend, I really kind of took it easy because it's been a really busy couple of weeks, and I just watched a whole bunch of movies. And yeah, it's expensive. I actually bought Hail Mary, which I was really excited to watch. I'm a science geek, and frankly, I didn't like it at all. I'm sorry. It was a major disappointment. It really was. At any rate, so what's interesting about this is inflation's still there, and you wouldn't know it. And people are so, kind of just complacent when it comes to the economy and the consumer. And if I hear one more person on TV tell me that the consumer is healthy and the labor market is solid, I'm just going to scream. It's either both of those narratives are completely untrue if you look at the data. Let's take retail sales. Along with GDP, they both posted above 4% year over year. And this retail sales number from 2 weeks ago, above 4. Oh my God, you would have thought that this was the second coming and the stock market is going to be up, 30% in the next 2 weeks. Big problem here. Big problem. When you take the dollar change for the month, gas stations accounted for 47% of the rise. And in that was in March, and that was actually that was in April. 47% in April, after 65% in March. People actually drove less because gasoline prices stayed pretty high. And by the way, every time the harbor delivery gasoline price gets to $3.70, that's when Trump folds and backs down. So just keep that in mind. All right. So you have gasoline stations, 47% of the monthly gain. And the year over year was higher because we had the roll-off of first quarter dynamic in 2025 that related to tariffs and front-loaded demand. And all of a sudden that fell off, and April last year was weak. So the year over year number was already skewed to the upside. The growth, the actual dollar growth, was almost, it was over half gasoline stations in the last 2 months. The other thing higher was online sales. So in April, 47% gasoline, 41% online sales. And this does add up to 100 when you take the pluses and minuses. All right. So this bottom line is people stayed home and purchased stuff and paid at the gas station, because eating and drinking establishment sales up for the last 12 months now hit 57 million on a rolling 12-month basis. It's usually in the billions, 2, 3, 4 billion if it's a really good year. All right. This is back-to-back lowest numbers since the pandemic. All right. And then not only that, everything else is pretty much flat except automobiles, which are down 2 months in a row because they're highly negatively correlated to gasoline prices. So what you see here is gasoline prices has completely clouded out, blacked out sales of most everything else on a discretionary basis. And inflation is basically the cause of that. All right. Not only that, the labor market, solid. Yeah. I said to somebody, I'm going to give you this line, even though, if you don't want to hear it, cover your ears now. It's as solid as diarrhea. I mean, that's what it is. I'm sorry. All right. Dropouts in the last 12 months have been 2.4 million. New jobs, non-farm payroll jobs, 251,000. First of all, that's the second lowest 12-month gain since the pandemic, and one of the lowest 12-month gains in history. I mean, it's a real flashpoint here. It is flashing red big time at only 251,000 over the last 12 months. All right. And anytime it gets below a million, it gets to negative every time. And it's 7 times going back to the 70s. So this is a problem going forward, and we know what AI is going to do. But let's just stick with the program here. We're 2.4 million dropouts in the last 12 months against 251,000 newly created jobs in the last 12 months, gives you roughly 2.14, let's call it 2.1 million new, unemployed that are not being counted. You add those to the 7.2 million that are counted as unemployed, and you have an unemployment rate of 6.1%. Now, the BLS gives us all kinds of indexes like this, too. The other one, and I noted this within my GMSR for the last 2 months in a row, the number of people working part-time for economic reasons is up by close to 470,000. Don't quote me on the exact number. It's around 470. It's just shy of 500,000. Over 2 months. That's a massive number for 2 months. And that's why the U6 total unemployment, which includes people part-time for economic reasons, is 8.1. Now, here's the great thing, too. Not great at all. I mean, the great thing about people that say that the labor market is solid. And that's the word I hear so much, solid, on TV. The participation rate fell for the 4th month in a row. It's 61.8%. It's below 62. It's never below 62. In fact, this is the lowest, except for 2020 when the entire global economy was shut down. It's the lowest since the 1970s. The lowest U.S. labor market participation rate since the 1970s. And when you look at the Fed's SEP, the forward staff economic projections, okay, the basically say that AI will have no impact because they see the unemployment rate staying between 4.3 and 4.5% through 2028. And yet, what do we just hear? Standard Chartered CEO, Goldman Sachs President, HSBC CEO, Jamie Dimon, JP Morgan, and the Morgan Stanley CEO all said in the last 2 weeks, we will be removing employees and replacing them with AI. It's going to have a big deal. So no wonder consumer confidence is basically the worst it's ever been. It's worse than when it was when Jimmy Carter was president. Come on. If that doesn't give you anecdotal evidence that the consumer is not healthy. The conference report, economic conditions, new all-time low. Current financial situation of households, new all-time low. Worse than 2009, worse than 87, worse than the 70s. The University of Michigan's even worse. It's a little jaded sometimes, but it's still what it is. I mean, it is what it is. 47.6. It's an all-time low by almost 4 full percentage points. Okay? The only other time, and it's still all-time low, below 2008 November, and below the May 1980 low, which was the all-time low at 51.7. It beat that by 3.9 percentage points. And that's the all-time low was 1980, when Paul Volcker lifted interest rates to 20% to defeat inflation. And people are feeling that much worse now. And by the way, you want to talk stagflation? That's the University of Michigan consumer sentiment. But the 5-year consumer inflation expectation rose to 3.4, the highest since May of 2008. That wasn't a pandemic number. 16-month high, highest non-pandemic number since May of 2008. Lowest, a new all-time low, but also taking out the November 2008 low. 2008, boom, on both sides, the stag and deflation. So let's talk about the stock market because everyone says, the consumer doesn't matter, the economy doesn't matter. This is all about AI and chips and all that's going to do. Well, yeah, it is right now because it's dollar terms. Our GDP is high because capital spending is tens and hundreds and, ultimately $1 trillion or more. So, of course, GDP is high when you're adding $1 trillion. All right. The problem is this is a bit of a one-off. All right. I mean, this spending is going to stop. This is not something that's going to go on for the next 3 years, not even probably for the next 4 quarters. All right. And while consumers and services still make up 71% of the economy, capital spending is 14% of the economy. Break it down even further in terms of measuring industrial production, understanding manufacturing is not a driving force, but pretty much everything that is going to be put in data centers is part of the industrial production report. Okay, especially when it comes to high tech. It's very high tech now skewed data set. And I decided to look at it just to see if I saw what I ended up seeing, because I had a suspicion I was going to see this. And it's right on. I mean, it really is. All right. The two highest gains year over year in industrial production are semiconductors, which are up 9.9% year over year in terms of output. Problem is, semiconductors is only 1.5% of the economy. It's 1.5% of the economy. The second one, up 14.5 year over year in terms of output, is computers and peripheral equipment. And that latter part's important because that is the part that interacts with semiconductors. You're talking about this up 14.5%. So these numbers are huge. The spending numbers are huge in dollar terms. So the gain in GDP is huge in dollar terms. But here's the problem. Computers and peripheral equipment are 0.2% of the economy. It's 0.2%. Semiconductors is 1.5%. Between them, they're less than 2% of the economy. When you throw in capital spending, you got 16% of the economy versus 71% for consumers and services. You see why it's so important? The consumer's choking. And the second this war is over, the second AIA data center build out and the tens and billions of dollars that are going to be spent on this that are announced seemingly every other week, all right, and the whole semiconductor craze, to whatever extent, is done, people are going to look around, look at the economy and go, this is what it is. This is what it is. I got to go back to my theme that I used back in 2008. The Wile E. Coyote economy. It's the Wile E. Coyote stock market, I should say. Because at some point, you're going to have the roadrunner runs off the cliff. He doesn't realize he's run off the cliff yet. He turns and looks at the roadrunner sitting there with his tongue hanging out. And then he looks down and he goes, uh-oh. That's kind of going to be the stock market at some point in the future. And that's kind of our piece. Now, another piece I did today, by the way, breaks down the data, the macro data in Asia. All right, and I look at three countries in particular, and I've been trading these currencies since the 90s. And one of my biggest plays, in my career through 1998 was being short the Thai baht. Made a fortune off being short the Thai baht for Commodity Corp, for Swiss Reinsurance, and partially for myself. So the piece today was Malaysia, Taiwan, and Thailand, and how they're dealing with this war. And you have numbers where, man, exports are off the charts to the upside. Imports are off the charts to the upside. And trade balances are either huge or the deficits are huge. And it's really interesting. But all in all, retail sales are strong. The economy's strong. Inflation is low relative to the rest of the world because they have a lot of trade with China for the most part, too. That's a big deal. But the biggest thing about it is these currencies, okay, when you look at the dollar and then you look at these currencies, you look at every other currency on the planet, there's one thing in common among all of them. Right now, gold is breaking down against all of these currencies. This is potentially huge. I don't want to get too excited about this, and I know that a lot of people love gold. I think there's going to be a huge buying opportunity in gold, but not before there's something potentially bigger to the downside. You have monetary conditions tightening further. You have a potential credit crunch. Right? You have central banks are going to raise rates. You have a dollar that's higher. This is all generating intensifying stagflationary pressure. So when you talk about all this and you see gold now declining against all currencies, implies there may be a liquidity trap emerging, a liquidity shortage, because you have monetary and credit conditions tightening so much here. Central bank's going to raise, the dollar's higher. Stagflation is intensifying. This could cause an asset price deflation event. So it's kind of time for safety right now. It really is. And then you wait for the next series of events, and it could take some time to play out. And frankly, to me, I want to make money the whole time. But for the average investor out there, this is a time for protection and safety and almost some cash, right? I never advise go to all cash because I don't want to screw people up if I'm wrong, okay? It's that simple, But I feel pretty confident about this in terms of the disconnect, the stock market from the economy, the dynamic around AI and spending that's going to run out, the fact that AI will cripple the labor market that's already crippled, and that the consumer pile demand is going to need to be saved. So what you're waiting for is the Fed, for the stock market to reconnect to the economy, which means some kind of significant correction. And by the way, consumer discretionary, new lows against the S&P. The retailers, new lows against the S&P. Online retailers, PNQI, new lows against the S&P. Financials, new lows against the S&P. Home builders, new lows against the S&P. Healthcare, new lows against the S&P. The only things making new highs against the S&P are the semiconductors, infotech, and energy. That's it. So it's a temporary, the clock is ticking, all right? The road runner is about to run off the cliff. And the degree to which that's when the Fed will have to ride their white horse back into the picture. You're talking about a bond market that probably may have to be saved. At the very least, the consumer's going to have to be saved because you can't service the debt, $56 trillion between we the people and household debt, unless you have final demand growth. If we don't have final demand growth, it's, say goodnight, Gracie. So the degree to which the Fed will be forced to acquiesce to higher inflation, which I've been saying for over a year now, this is ultimately where we're going. And then that would be the dollar card being played. And that's when you get a bottom in gold and silver. And that's when you get the next new highs, $10,000 gold, $325 silver. Those are the longer term targets. But I think a significant decline could be first. And this could be a total kind of asset price deflation because of all the tightening of monetary conditions against everything else. The only thing saving us right now is the AI data center spend and these companies that have benefited from that. That's it. Show me something else that's really good out there right now. And then stocks will recover ultimately towards the end because the lower dollar, best thing in the world for stocks, and that's why it always recovers because they perpetually depreciating the dollar, which is why we do this to help investors protect and do all these other things and trade these other markets and be long and short everything if you can in the futures market. Best way to do it, or invest in a great CTA, many of them out there, as to protect the purchasing power of your wealth, income, and money. All right. Now, for me, if you want to get some copies of the work, happy to send it to you. There's a lot of good charts in any of this stuff. Just the piece on the Asian gold would be a good one, but it's a lot of Asian macro stuff too. So anything I've done on the U.S., you want to see it, just shoot me an email, Greg Weldon at Weldon Online, GregWeldon. I'm on Weldon at Weldon Live on X. The podcast at Money_podcast, and the lovely Anna is my producer. She will take good care of you if you contact us through there and get you hooked up with whatever it is you need. I don't really like to be gloom and doom, so I'm always trying to find things positive. And the New York Knickerbockers are in the NBA Finals. So right now, I'm pretty ecstatic, no matter what the heck is going on around the world.